Hello, I'm Alan Kohler, founder of Eureka Report, which is now part of Intelligent Investor, which Money Café is also a part of. And I'm a finance presenter and columnist for the ABC.
And I'm James Thomson, senior Chanticleer columnist at the Australian Financial Review.
And we are the Money Café.
Yay.
G'day, James. First
Hello,
time
Alan.
back this year. Good on you.
Yeah, Happy New Year to you and all the listeners. It's probably too late to say that in February, but I'm doing it anyway.
Do it anyway. This is the first time we've spoken to you, so that's great. Okay, let's get straight into it. There's a bit going on overnight in Wall Street. Software stocks were smashed, and you've been writing about it this morning. Tell us what's going on.
Yeah, well, a company called Anthropic, which is one of these rivals to OpenAI, they have a large language model called Claude, which is similar to, ChatGPT or Gemini, which Google has. They have released a new tool, a legal tool that promises to sort of automate tasks like contract reviews, compliance stuff, legal briefings, templated responses to clients. Now, that has sent absolute shockwaves through the software sector, basically because everyone's thought, hang on, if Anthropic can do this to the legal sector, who can't they do this to? And investors have basically decided we don't want anything to do with software. Some of the moves are extraordinary. Consulting and analytics firm Gartner, it's down 22.5%. The ratings agencies, S&P Global and Moody's, down 10% and 8% respectively, based on the idea that, that what they do is crunch data. Hey, Anthropic's going to be crunching that data soon. Even the local hero Atlassian, this is a remarkable story. They're off 8%. But it's worth noting, Alan, these fears about what AI could do to software businesses have been building for some time. And Atlassian, which is, of course, Australian born, is a great example. The stock was down 50% last calendar year, so 2025 calendar year. Since the start of this year, though, it's down more than 32%. So this Anthropic news about with the legal tool has really sort of catalyzed a bunch of fears that have been growing for a while. It's worth noting, Alan, too, that like Australian software stocks have been smashed up in the last 6 months or so too. Xero and WiseTech are down 45% and 50%. We're speaking on Wednesday morning before the market opens, so who knows what will happen today. But this is a sort of developing story, I think. The disruptors are well and truly being disrupted.
Well, I was going to say, I don't know why everyone's surprised because, this has been coming for a while. But as you say, this is not a surprise. I mean, they just happened to fall some more today, but they've already been falling because of AI's expected impact on software businesses. I
think this Anthropic thing has just sort of taken it mainstream. Everybody realizes what's coming for them now. So,
well, I guess Anthropic's new legal software, whatever it is that Claude's going to do, would have made the stocks, if there were any, of legal employees collapse as well.
Yeah, that's right.
I mean, if they're going to completely do all that routine stuff that law firms do, then law firms won't need to hire juniors anymore.
So, some of the biggest hammerings, though, strangely enough, are in private equity and private credit. So big private credit firm Blue Owl down 12%, Blackstone down 5%, KKR down 9%. The estimates suggest that sort of 20% of the portfolios of private credit and private equity firms are tied up in software. And so if you're sitting there with a private software company looking at, stocks down, software stocks down 35% in the last, 5 weeks, how do you mark the value of your privately held businesses? I think of Canva, Australia's great privately held business, worth $65 billion at the last count. How far do you have to mark that down now? Is it 20%? Is it 30%? Is there another reason that it's only 10%? I got no idea, but this is going to seep through lots of different places.
We've got a good question on this subject, so why don't we just return to it with the question?
Absolutely.
And talk about the RBA now. Now, you wrote this morning.
A symbol of a mediocre economy.
Yeah, so please explain.
Well, I mean, what we've got here, I think the problem with this rate hike is that neither the RBA or the government can come out and say, hey, this is just what happens when the economy is booming, because the economy is not booming. This is what happens when very low productivity growth limits the rate at which the economy can grow. I mean, we're essentially speed limited, so we can't grow any faster than 2.1% around there without sparking inflation. The long run average since 1960 for economic growth is 3.3%. So this is a mediocre economy growing in a mediocre way, and my view is that partly this has got to do with mediocre government over a long time. We've had no productivity reform. We've now got the government, in the MYEFO, the mid-year economic and fiscal outlook, government spending, jumped 17 billion over what it was in the budget. So Jim Chalmers, I know he's making the point that the RBA is blaming this on surging private demand, but he's not helping. And you look at what's happening in Canberra. If there was an effective opposition putting some pressure on Labor, maybe this message gets through. But instead, the opposition's disintegrating. Again, so I just look at mediocre politics, mediocre economy. I think it's not a great moment.
The Reserve Bank kind of spelled it out in the Statement of Monetary Policy that comes out at the same time as the decision.
Yeah.
And in that statement, they said that September quarter GDP growth was 2.1%, which they say is the potential growth, roughly the potential growth of the economy, 2.1%. And although we haven't got the December quarter GDP numbers from the ABS yet, they say that the data since then shows that the growth in the December quarter was above September quarter, which means that it's above potential growth. And potential growth is, as you put it, the speed limit. Yeah. And that's fundamentally why they increase rates, because growth has suddenly outstripped potential growth. And that's it. As you say, it's we've got potential growth of 2.1%, and average growth over the past few decades has been more than 3%, and so that's what's changed. And I put a graph of the of productivity growth on the news. I mean, there last night, and the RBA's forecast of productivity growth is also in that Statement of Monetary Policy, and it's 0.6%.
Yeah. What's the average over the last 10 years, Alan? It's 0.3%.
Oh, I see. Yes, over the last 10 years. So they're predicting it's going to pick up.
Yeah, the RBA is expecting productivity growth will double the 10-year average. I mean, even that might be ambitious.
That's right.
I just it's I don't really. I know there's going to be lots written about is the RBA's forecasting right, all that stuff. That's all justifiable, but we've got a bigger problem than an interest rate hike here. We need to get real reform going. We've got to get this economy going again. I'd just ask listeners to ask 10 of their friends. Does this feel like a booming economy that warrants rate rises? No way.
No, that's right.
I think it's a bit disheartening.
Okay, on that sober note, let's move on to what's been going on in the markets, which has been a lot in the past week or so. We saw gold and silver crash.
Yeah.
Last week.
Surge, then crash, yeah.
Well, yeah, it's been surging for a little while. I mean, it's basically been particularly silver, it's been a speculative bubble.
I think that's silver. Right. Yeah.
And it fell on one day 36%?
Yes.
Last week.
Yes.
And a lot of people put that down to the nomination of Kevin Walsh as the new chair of the Federal Reserve. I'm not sure that's right, actually. Apart from anything else, it's not entirely clear what the hell Kevin Walsh thinks about anything. I mean, is he a hawk or a dove? Who knows? Nobody knows. I mean, the idea that you sell off silver because of that is crazy. I mean, and it's clear that the fall in silver didn't happen at the same time as his nomination was announced, or even when the punting, the rumours started circulating. It was some other time, and the reason for it was that Chinese speculators had been piling into a fund called the UBS Silver Futures Fund, and that's the biggest kind of silver ETF basically, and they've been piling into that. And what happened was that the commodity exchange increased the margin requirement for speculators, and all of a sudden they had to get out because they couldn't meet the margin requirements. They're all kind of on highly leveraged futures contracts, and that was what caused it. It was a sort of a rush out of silver futures contracts by Chinese speculators.
Yeah. I mean, the Wash, whether Wash's the announcement around Wash was a bit of a catalyst. You know, the US dollar did rise because while Trump has appointed Wash and made it very clear he expects rates to fall, the market sees Wash as a bit of a hawk on inflation who could actually increase rates over time. And that's why you saw the US dollar rise and even bond yields tick up last Friday night. So that it didn't help the silver and gold case, because that, you know, the rise in silver and gold's been all about this debasement trade, which everybody loves talking about. And the idea there is that the US will essentially let the value of the US dollar fall because it's A, good for exports, and B, it reduces the real, in inverted commas, value of its massive debt pile. So everybody's been saying, okay, well, if the US dollar is not going to be worth as much as it was, I'm getting into gold, and then subsequently they got into silver. So, yes, we've seen a speculative mini bubble in gold and silver. I think that's clear. We've seen that we've seen that sort of explode or be pricked in the last little while. But I wouldn't. Alan, do you think it's possible that gold and silver start climbing, perhaps in a more orderly way once again?
Oh, well, I think it's fair to say that the US dollar is on the nose around the world. That began, or it sort of got accelerated by the Russian invasion of Ukraine in February 2022, when Russian assets were frozen in US dollars, and a lot of other central banks and governments thought, well, gee, this is bad, we better get out. But it's also true, I think, that people are looking for an alternative to US dollars, and so they're looking, and there's not much around. I mean,
yeah, that's right.
You know, there's no point going into another currency because they're all getting debased by the governments as well. So really, and Bitcoin is too kind of flighty and speculative. So really, it's gold and silver.
Yeah.
But the thing is that it seems to me that what's been going on, particularly recently, is not so much a kind of what you might call a sensible exit from US dollars into gold and silver reserves by central banks and so on. It's pure speculation.
Yeah.
You know, in futures contracts, and it's worth remembering that the price that we quote, the gold price, is actually driven by futures, not by the price at which gold and silver are sold on, by the bullion companies. They actually work off the futures, the front month futures contract, which is the first. So in February, the front month is March, the March futures, and that's the price that everyone uses to price gold at. So the whole thing is built around futures contracts, and futures contracts are basically one contract equals 100 ounces of gold, and you only need $10,000 to do it. The leverage is enormous. People are just speculating, that is to say, gambling on futures, and so the whole thing. The whole kind of pricing of gold and silver, although we talk about it as being an alternative to US dollars in central bank reserves and so on, it's actually just a speculation.
Yeah.
It isn't really. That's not what's going on. What's really kind of causing the prices to go up and down? What it is speculation.
Yeah. Well, it's been a fascinating market. As you say, in the last week, so much of this is driven by retail punters now, rather than sort of big institutions or all-knowing and all-seeing institutions who are usually neither. So, look, it's going to be fascinating. What did you make of Wash, though, Alan?
Is that how you say his name, Wash? I've been saying Wash, but
I don't know. Probably Kevin Wash.
It's just probably. Well, no, I haven't heard. I haven't seen
Wash.
Wash
sounds much less harsh, doesn't it?
Well, I just don't know what he says what he calls himself. I haven't seen any YouTubes of him talking, saying his own name.
Yeah,
So
let's go with Wash. Good point. Is he a hawk? Is he a dove? Is he a bird? Is he a plane? I don't know.
Well, I think the idea that Trump's going to put anyone in who's going to raise interest rates or want interest rates to go up rather than down is crazy. So obviously he's a dove. The reason people think of him as a hawk is because he's been carrying on about how the Fed shouldn't print money. But what he's been saying is that if the Fed stops printing money and goes into quantitative tightening instead of quantitative easing, then as a result of that, interest rates will come down. But that's rubbish. I don't know what he's talking about.
Yeah. It's fascinating stuff around his sort of view on, like he's got big problems with the Fed's use of data, the Fed's level of transparency, the Fed's modelling. We could get a very different sort of Fed under Wash, that's for sure. And maybe one that's a bit harder to follow, a bit more mysterious. I don't know if that's a good thing or a bad thing. Maybe it's a good thing.
Yeah, I did. Someone said that he might not do press conferences after the decision.
Yeah. He thinks the Fed talks too much.
Yeah. So I don't know.
Won't he think of the journalists? We love those.
Well, his boss, Donald Trump, who is clearly his boss, he talks too much. He talks all the time.
Yeah.
So I don't know. But look, I think, I think this is going to be a Trump. Well, Trump's trying to make it a Trump Federal Reserve. Whether Walsh does that, I guess, I suppose, who knows?
Yeah.
It is true that Trump appointed Powell, and when he appointed him, he said what a fantastic fellow he is, and he's going to be the best Federal Reserve chair of all time, and all this. But then fell out and started abusing him bitterly, flagrantly, extravagantly abusing him. And so maybe I don't know. Maybe that'll happen with Mr. Wash.
We'll wait and see. Should we do some questions?
Let's do that. But first, here, let's have a quick word from our sponsor.
Think investing's out of reach? Think again. With InvestSMART's Fund Later, you can own a $10,000 ETF portfolio with just $4,000 up front. Fund Later covers the rest, lending you $6,000, which you repay over 20 monthly installments, including a facility fee. There's no interest, no margin calls, and no waiting. Whether you're new to investing or a parent looking to give your kids a brighter future, it's a smart way to fast-track your investment journey. Choose from 4 expertly managed portfolios and get $10,000 working for you from day one. Learn more at fundlater.com.au. Terms and conditions apply.
Okay, first question is from Luke. Treasurer Tim Chalmers, he says, unashamedly cites Paul Keating as his political idol, the man who gave us record high interest rates of 17%. Jim seems to be following in the same footsteps by not taking his foot off government spending. With inflation still a concern, how do you assess the risk that continued high government spending puts upward pressure on interest rates? If you say it is with Jim to reduce government spending, can you get him back onto your podcast to talk some sense into him?
Well, certainly, Jim was very quick. Within moments of the RBA decision, he was very quick to say, to point to the RBA statement and say, hey, look, they're blaming accelerating private demands, not government spending. Don't listen to me, listen to the RBA. So, but I think, there's a huge focus on this May budget. How does Chalmers and Albanese get the balance right between government spending, actual reform that might make a difference to productivity, and reducing some of those inflationary pressures, and winning votes across as budgets are always about. So I think this strikes me as one of the bigger budgets in recent times, Alan.
I agree, and I think the fact that it's in deficit and will be in deficit in May is inherently, by definition, stimulatory. I mean, a deficit stimulates the economy, and the surplus does the other. Does the other thing. It contracts it, and so the Reserve Bank and the government are now, by definition, at loggerheads. The Reserve Bank is trying to slow the economy, and the government, through fiscal policy, is stimulating it.
Yeah,
it is true that the Reserve Bank did say in the releases and everything that the main problem is private spending is going faster than expected. But it's also true that government spending is increasing.
Yeah, and
has increased.
Yeah, and I think as much as Jim's sort of says that, look at what the RBA is saying, I don't think that's going to lessen the focus on government spending. So the May budget will be a big one.
Oh, and by the way, I'm interviewing Jim Chalmers next week for my new podcast series for the ABC. So that'll be interesting. And I'll ask him all that stuff about government spending.
Very good. Very good. All right. We've got two questions on AI. One from Dominic in Darwin and one from Jonathan. Dominic's referring to an article that was in the Murdoch Press with some comments from Hamish Douglas, who basically said that investors who are holding the in broad stock market indices like the S&P 500 and the ASX 200 are going to be caught in a killing field because AI is going to revolutionize the entire economy over the next 5 years. And then Jonathan says he's interested in hearing our thoughts on a theory he has. If we see a crash in AI stocks, could this counterintuitively increase the adoption of the use of AI in the workspace? Say hypothetically AI can perform a person's role at a company within 80% of human performance. So the mass rollout of AI replacement is held back by the better performance of humans. But with tightening budgets, as we'd see in a share market crash and AI being significantly cheaper, could this become a more cost-effective solution? That's an interesting theory, isn't it, Alan?
Yes, I'm happy to get into that, but I don't know. I don't understand why it's going to be a killing field. It's ETFs, right? Is that the proposition that Hamish?
The proposition is that the sort of mainstream stocks. This is Hamish's Douglas view that the mainstream stocks that currently make up the index are all going to be disrupted by AI, and we're going to see new businesses emerge that are, AI native, I guess, that spark waves of disruption. And so holding the index as it is now is not going to be a very safe place. You need to be a lot more choosier, is Douglas's argument about where to find winners and losers.
Right. So, because the big stocks in the ASX ETF are BHP and CBA. Will they be disrupted, do we think?
Not sure. It's a good question. I mean, harder to see BHP disrupted than CBA, I reckon. Sometimes in a quiet moment, I will sit there and think about, okay, so AI now reckons they can take a lot of the jobs out of a law firm. These AI models are all through the banks, right? How long will it be till the AI models have ingested all the data they need, got their heads around the workflows inside a bank, and they could team up with some sort of pool of capital to start offering the services that a bank offers with zero costs and very high deposit rates? So I don't know. I think it's you can sort of think through that example and get to a world where even a giant like CBA is disrupted.
I know, but the big customers of the AI businesses are going to be companies like CBA. They're the ones going to be buying all the AI in order to replace their workers, which gets us to Jonathan's question, I guess.
Yeah, but how does CBA once you let these guys in the door, how do you stop them then? I mean, replicating what you're doing. How many law firms would be asking that this morning after what Anthropic's just done? Why did we let these guys in again? Now they know everything about the legal industry. I think it's a really interesting question.
No, but it's interesting. The law firm, the software crash on the market last night, and over recent times, is not because not the crash in the share prices of law firms. The expectation is that they'll switch from the software businesses that they're currently buying services from, such as Atlassian, to Claude or ChatGPT, right? That's the proposition, but that the law firms will, presumably stop employing people.
Yeah, but I guess, Alan, if you're going to spend $5 to $7 trillion US on building AI infrastructure, do you think you just stop at the software industry?
Oh, I see. So
on
they'll
your
start
push to
replacing law
monetize?
firms. I don't know. Yeah, I mean,
Yeah.
will Claude become a bank, or ChatGPT become a bank to replace CBA? I don't know. I mean,
I guess my point would be it's a lot easier to imagine that than imagining Claude becoming a miner digging copper in
oh yeah,
Ecuador.
I guess that's right, isn't it? But so what's Jonathan on about? I mean,
So what Jonathan's saying is, let's say we have a share market crash that causes, a downturn in the economy because companies are now looking to cut costs. Do they actually increase their implementation of AI to do that? Ironically,
oh well, I think that's chicken and egg. I mean, the reason there'll be probably will be an AI crash is because the investors realise that the revenue from AI isn't going to match the money that they're paying for these companies, because it probably can't. But the truth is that if it does, if it isn't a bubble and that there is no crash because the AI is worth what everyone's paying for it, then it is going to replace everybody because that's how they'll make their money.
yeah.
So, I mean, there is a kind of paradox about it, which is that how do these AI companies make money if everyone's out of work and the economies of the unemployment is 50% or something, and there's nobody's making any income anymore, and the UBI, the universal basic income that they're getting, is nowhere near what they used to get. So, I mean, I don't know what the answer to that is. I think that I asked ChatGPT to give us an average of all of the estimates of permanent unemployment as a result of AI, because the estimates range from 0 to 100%, with Elon Musk saying that AI will replace all jobs, and other people say that no, it'll be fine. There'll be no unemployment, and it'll just, all that AI will do is enhance existing employees.
Yeah.
And the answer was 34% permanent unemployment as an average of the predictions that are being made by all sorts of various people.
Well,
I don't know. What do you reckon? 34%?
doesn't sound crazy to me, but that's a pretty doomsday scenario. I mean, I would just imagine what the Australian economy looks like with unemployment running at 10% or 15%.
I know. I mean, anything more than 10% is pretty doomsday-ish, isn't
Absolutely. Absolutely.
So, really.
Yeah.
And it isn't going to be zero, right? I mean, it isn't going to be, current unemployment is like 4%.
Yep.
I don't know. It's not going to, surely it's not going to stay 4%.
Yeah. No, good question, Jonathan. Your turn, Alan.
Brad says, I'm 30, based in Adelaide, have a mortgage on an investment property. My mum has recently gained access to her super and is looking to help me financially. She's proposing to lend me a lump sum to hold in my mortgage offset account as a loan. As a loan, it would remain repayable to her, offer some protection in the event of a future relationship split, and reduce interest on my mortgage. Does this sound like a good idea, or is there a more efficient way to do it? Well, it's one way. I don't know. I mean,
very hard, Brad. Very hard to know what your circumstances are and what your mum's circumstances are. I would get advice on this, because you don't want to trip into some sort of tax implications for either of you, and you don't want your mum, who's just got access to her super, her life to become overly complicated either. So I presume it's a reasonably large amount of money. And it's a fine sentiment of your mum. So I would go and get some advice, because it's going to be very dependent on your personal circumstances of, we don't know if you've got what other debts you might have or what other issues you might have. It's just really hard for us to say.
I mean, it's worth just discussing it a bit, because I think a lot of families have these kind of issues to think about. And it seems to me, the first question is this spare money from your mum? I mean, does she need the money? Does she need a return on that money or not? When you say it's a loan, is it an interest-free loan? Or do you give her repayments on that in order to help her live, or is this money that she doesn't really need to invest at all in because she's got other income? So she's fine. So, because if it's completely spare money, I would have thought she should just give it to you. And also, it depends a bit on how old she is. I mean, if she's if she's 60 and got 30 years to live, then, basically she probably needs the money eventually.
Yeah.
But if she's 90, she might as well give it to you. I mean,
that's a good point. The question of how and when your mum might need the money back is pretty important, isn't it?
yeah, that's right. I mean, is your mum saying she doesn't ever need that money back and that it's always yours, in which case...
Or it's just, stick it in the offset account for the next 10 years or 3 years or 2 years or 1 year to save a bit of interest and then I'll need it back?
Yeah.
That's an important question.
In our family, it's not so much the bank of mum and dad as the Santa Claus of mum and dad, because we've just given the kids some money. I mean,
yeah.
And also we haven't worried too much about future breakups. I mean, yeah, I don't know. I mean, are they going to break up? Or how do you protect against that, really? I mean, the fact is that the spouse is entitled to 50% of the assets. So, unless you have a prenuptial agreement or some conditions on the loan that it's always only just the child. I mean, I don't know.
Yeah. Cal says, long-time listener, first-time emailer. I'm a young person trying to get into the housing market. My job in IT is threatened by AI. The global geopolitical situation's in chaos, and climate change is causing record heat waves around the nation. I enjoy the podcast, but it's usually a pretty grim listen. So my question is, got any good news?
I don't think... Are we a grim listen usually? I don't think
Maybe it's
so.
my fault, Alan.
No, you're fine. I don't think we're that grim. But anyway, look, I think as he lists it, the circumstances are a bit grim, aren't they?
Yeah. I mean, this is the message from Davos that the world is going through a big sort of moment here. There's no real point sugarcoating it. There's always good things happening, though. Where for all those worries about AI, the possibility that AI can make our lives easier or create some sort of medical breakthroughs, that's very real. It feels like we're on the edge of quantum computing. Hey, share markets are still at record highs. Australian household wealth is absolutely booming. Now, I accept Cal's point that doesn't make it easier to get into the housing market. But I guess the good news is, Alan, we're not like we're facing into that grimness from a reasonably solid base. We can have a crack at fixing some of these things.
I mean, one of the good things about AI is that it means we've stopped talking about the problems of climate change for a while.
Yeah.
I mean, we're just talking about AI now. Climate change is off the agenda. We're not even worried about it anymore. But of course, it's still there. It's still happening. And, we've had one hot day this summer in Victoria, at least. Anyway.
I might just come in here with Marcus's question, Alan, because it relates to that. He's been looking at the performance of his share portfolio over the last year. A big part of his portfolio is both Australian and US-based ethical ETFs. The performance on both has been woeful, actually going backwards in a year that the market overall has gone gangbusters. And Marcus is saying it seems to be a long-term trend. Have you noticed a shift in the market sentiment to favour or at least express ambivalence to ethical investing? How big is the Trump effect in that regard?
Well, at least you're ethical about it, Marcus. You're losing money, but at least you feel good about it. I mean, I suppose the problem is that Trump has completely reversed the trend towards, emissions reduction in the US, at least. So I think that's probably been a problem for ethical investment sources, ethical companies, because he's got drill baby drill going on.
Yeah. And it's been like very difficult in the last little while for particularly wind projects have really struggled. And so I imagine that's where some of the ethical players had their money tied up. The ethical ETFs have also sort of, I know, struggled with how to get in on AI because, yes, it's not immediately unethical, but it does use a lot of energy, power, water, and so that has been a bit of an issue. Maybe they haven't been as leveraged to tech as you might have wanted to be.
I mean, on the subject of pessimism and optimism, it's worth perhaps noting is I listened to a podcast of Elon Musk over the holidays, and he said that he used to be pessimistic, but he decided to be optimistic because it's better to be optimistic and wrong than a pessimist and right. That's what he reckons. I don't think that's true, but anyway.
Yeah, I'm sure there's something to be said about taking advice from Elon Musk here, but
you're speechless about that, aren't you? Speechless.
I just don't. Oh yeah. Anyway, your turn, Alan.
Probably got time for one more question, which or maybe two. Anyway, Mick says, "Love the show and been listening to from the very beginning. I have a question on valuation. The general consensus seems to be that the markets look expensive when viewed through historic PE ratios. I'm wondering whether it's less about the P needing to correct and more about the E being on the cusp of accelerating. One possible justification is that companies are materially reducing labour costs through the rapid emergence of AI, effectively replacing augmenting workers. I think this is an aspect of AI that and ETFs and that we could probably worth looking at. I mean, I think there is a proposition that we're about to see an explosion in productivity globally.
Yep.
As a result of AI, which in turn will increase all companies' revenue, not just the AI companies.
Yeah, but even backing that out, Alan, Mick's right. The E in the PE multiple is what everyone's watching this year. I think in Wall Street, the sort of projection for the index is something like 12% earnings growth in 2026. Similar in 2027. That's a big gains, and that's not banking a whole lot of AI gains, although it's probably banking a bit of cost savings from labour in there. And in Australia too, we're about to see the E go through the roof, mainly as a result of high commodity prices, which are going to help resources stocks really deliver some big profits. And frankly, we need that to happen. We've had 3 consecutive years where at an index level, earnings have gone backwards. Now, sort of we're talking about a mediocre economy and political situation before in relation to the RBA. That performance from our biggest companies has been pretty mediocre too. So we will see that improve from the resources stocks over the next 6 to 12 months. So yeah, we are on the cusp of a bit of an earnings boom. Now the question I've got, Alan, is does that keep propelling stock markets higher, or does it just mean it justifies the current very stretched valuations? So I think that's the bit that's tougher to answer.
Yeah, and the question I have, does that apply to iron ore, which is the main mineral that Australia digs up, and Australian big mining companies dig up and sell? And, I think that's probably everyone's saying that it certainly refers to copper and rare earths and all that stuff.
Yeah.
Gold and silver are also booming, of course. But what about iron ore? I mean, that depends on the Chinese economy and in particular Chinese construction, which is kind of heading south.
Price is still holding up really well at $105 a ton for iron ore. I mean, logic says, given that the US construction sector is in the toilet and has been for really 4 years, and also that the Chinese are pumping a lot of steel into electric vehicles, which they're clearly producing too many of, more than the world needs. You would think logic says that there's going to be some pressure on the iron ore price, but China's ability to juice its economy with debt and keep growth rates high, it's probably the wrong thing to do long term, but there's no backing away from it. And while there's no backing away from it, the iron ore price, probably stays pretty solid. So, yeah, we're one day that China's going to have to try and rebalance its economy, and that's going to be very painful for us. But I don't know when that day is. China watchers say, it's going to have to be in 2 to 3 years because the size of the Chinese debt's just so immense. But, they've been saying that for a little while too.
Yeah, that's true. Well, I think we better leave it there. Thanks very much for listening, everyone. Thanks, James. Good to talk to you again for the first time this year. And thanks, everyone, for listening. I'll be back next week with Stephen Mayne. So send in your questions to the Money Café at eurekareport.com.au. Until then, I'm Alan Kohler, person on the ABC and a part of Intelligent Investor.
And I'm James Thomson, Senior Chanticleer columnist at the Australian Financial Review. Talk to you soon.